I'm selling X in the present because of what, Kevin? Well, because of something that happened in the past. And you could see that in the price charts, right? That's what we call resistance levels, support levels. It's an actual thing, guys.
We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pain.
That's going to be bonkers.
Okay, everybody, great to have you with us. Welcome to another episode of Talking Trades with myself, Kevin Wadsworth, and my friend and colleague, Patrick Karim. Patrick, how are you doing today?
Doing great.
We've got a great topic for you today, something for you to really think about. If we look at historic data, every cycle since the 1970s has whispered the same signals. It's given the same signals, the same sequence. Pat, what are we talking about here, and what can we learn from that statement?
Of course, I'm going to show you the charts, guys. But before I show you the charts, sometimes we hear cycles. They don't matter. The market is forward-looking. It doesn't matter what happened in the past, and that just doesn't make sense, guys. Of course, what happens in the future, it will be impacted by what happened to the price, right? Like, just if you think about it rationally. If I buy a stock at $100 and then either the price doubles, and then after that, my target was to take profits when I do a one bagger. Of course, I'm going to take profits. So that means I'm going to sell, right? If I sold, I'm selling because of something that happened in the past. And same thing on the way down. I could have bought something at $100 and the price went down. And then after that, I just want to cut my losses. Then I want to sell when the price is X in the present. Well, I'm selling X in the present because of what, Kevin? Well, because of something that happened in the past. And you could see that in the price charts, right? That's what we call resistance levels, support levels. It's an actual thing, guys. So I don't know why you could look at the future and totally dismiss what happened in the past, because the future is not just forward looking. It's also people that took actions in the past that will take future actions in the future, right? It's buying and selling nonstop there. So please, guys, bear that in mind. All right, I hope everybody sees this. Before you guys start zooming on everything, I'm just going to show you one pane at a time. This is step one. So like Kevin said, since 1970, it's the same sequence of events that unfold over and over again, painting the backdrop of the macro landscape, which is going to make a total difference between is our growth stocks going to outperform value, or is value going to outperform growth stocks, right? And growth is like the SPX, NASDAQ, speculative stuff, Bitcoin. And the value stuff, well, it's more like commodities, gold, silver, uranium, copper, platinum. Insert your favorite commodity in there. And I broke this down for you guys in 3 easy steps, but it could have been 4, 5, 6 steps, right? It's a weight of evidence approach. So here I have the Fed fund rate. Step number 1, Fed fund rate cut. When you have Fed fund rate cut, it sets the stage for a possible unfolding of this capital rotation, right? That's going to go in gold and friends instead of the stock market, right? The Fed's not cutting rates because everything's doing great in the economy. They often cut rates because they want to start creating stimulus, that unemployment is going to start going up. And that's going to be my step number 2. I'll show you that. A whole bunch of stuff's not going too good according to their metrics, and they're starting to cut rates to offset that. But also it could have been just them tracking the 2-year yields. They're very closely tied. So here you see in the 1970s, here's a first rate cut to deal with some issues in the markets. Here's a second rate cut, and here's a third rate cut. And you'll notice that these rate cuts, higher highs, higher lows. So while there's crazy fluctuations within this, the trend is it goes up with huge cuts on the way down. And here we have the bull. That was the bull era, guys, for gold, silver, oil. Like everything went bonkers there, and the markets just went sideways. Here in all the way from the 1980s, all the way down here there, and even a little bit after. Same thing. There's recessions within this bull era for the stock market. Lower highs, rate cutting cycles to deal with these issues, but it's still in a disinflation type of environment where overall the rates are just going down, which fuels growth, which fuels whatever the spending to help the stock market to go up. And look what's happening again now. Oh, look at my arrow. We're starting a new cycle where we did a new high right here, just like we did in the 70s. See these high on these, the way they're able to reflate. Here we have a higher high. And now we're starting a rate cutting cycle, which eventually, possibly, where a recession is going to be looming right here. And if it continues going downwards and something like that, right? They're going to cut to try to save the stock market, but they can't cut too much eventually, because if the recession starts picking up, then after that, we might have a new secular cycle here. So that's step number one. You need a first cut, which happened for the Fed, signaling this possible recession. Because remember, it's the reaction to the recession, the government public debt acceleration, all that stuff to try to stimulate bailouts, etc. That's what changes the dynamic from growth to value. So that was the first step, guys. Here's my second step. The U.S. Initial jobless claims. You could look at the unemployment rate. Initial jobless claims also gives you that same indication. And remember, rising arrow right here, higher highs. Even when we get these recessions, which resets the initial jobless claims, because remember, they started doing the stimulus to help save the economy. It can't fully reset back to the levels it had before in those jobless claims. And what happens after that? You go back up. And as long as you're in this dynamic, oil goes bonkers, silver, that's where it outperforms, those commodities outperform the stock market. The stock market just went sideways. Here's the inverse. Look at that. U.S. initial claims, even if there's spikes, look at that lower high here. And after that, guess what? Look, we have a new cycle here in favor of the precious metals. Higher high on the unemployment, the initial claims, higher lows. Not as aggressive, not as violent as it was in the 1970s, but a little bit still going higher high. And look where we are today. We had the Fed that started cutting, but the initial claims haven't broken out yet. And it's probably one of another key moment where the market participants are going to realize that, hold on, this is going up. And remember, the markets rolled over hard here in the 2000s, right? They rolled over hard here in the GFC. So there's a clear breakout line here. I have it set at 241, but it could be a solid close at 245. You want to see it start to trend upwards. So this step number two is the initial claims going up, which it's starting to, but not in a meaningful way like it previously did. And that will probably be the instigator for those short-term yields to keep dropping, for the Fed to keep cutting and start building out what I showed you in step one, where the Fed fund rates cut, they do cycles, but higher highs, higher lows, and then we have a rotation into precious metals more. Final step, the gold versus SPX ratio, gold's performance versus the SPX. And you'll see it's the same thing. Gold follows those two previous charts, those cycles, right? Higher highs, higher lows, all during this area, guys, the 70s era, when they had the initial claims going up, then down, but can't fully reset. You have this huge bull run for the US equities outperforming SPX. SPX went sideways, but of course, the gold, silver, oil, they just went bonkers. Here's the disinflation period where I showed you, same thing, those tracks. I'll show you again, guys. I could overlay. Look, I'm just going to click and drag it for you guys. Look at that. I overlaid the gold versus SPX chart with the US initial jobless claims, and they trend together. Look at that. They trend together, guys. Look at this. Look at the trend together. And here's gold outperforming SPX. So you have macroeconomics data points, US initial jobless claims, has nothing to do with buyers and sellers. It's purely macroeconomics, the business cycle. And you have the markets trading the ratio of gold's performance relative to SPX in the same manner. It's not perfection, but you could clearly see the trend together, right? Look at this. And look, even here, they're climbing. Here's the initial claims trying to climb up. And guess what's doing the gold versus SPX ratio? It's going up. So it's like a Rosetta Stone, guys. That should you should really wake up to this and say, oh my goodness, all these are intertwined, right? It has nothing to do with COMEX, manipulation. Forget all that stuff. This is pure market forces at the highest level, the purest level, at the most important level, playing out in front of you. So step number three, even here in that 2000 run, guys, to 2011 run, when gold outperformed SPX, that you could almost consider that a bear market rally in favor of gold versus SPX, carving out this potential breakout line. Here's one reaction, two reaction. And whatever's happening now, we're probably going to have a third reaction right here on that line. I'd love to see a third reaction. And once we break out of that, at a valid trend line that started in 1980, retagged in 2011, and a breakout maybe in 2026, 2025, that is crazy, crazy paradigm shift breakout line. This is stuff that you'll never, very rarely see, right? It took 45 years for this thing to build out. And of course, you're going to get a crazy bull era for gold, silver, copper, uranium, oil. And I most likely, because of that recession stuff I showed you before on the previous charts, with the unemployment rate or initial claims going up, the Fed fund rates going down, this will highly likely happen with the stock market dumping. So as the market starts rolling over, gold holds its ground, that thing skyrockets up. And once that's done, it's like some major, major shift there where anybody who's participates in the investment world should really take heed of this and prepare accordingly.
Mesmerizing stuff there, Pat, and hopefully a light bulb moment for a lot of people watching this. If you like that and you want more, don't forget to hit the like, subscribe, and notification bell for a lot more like this. But for now, goodbye.